Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, so we are from group 7. The members are Aisyah Rahmah Tianny, Nadila Delfira Pitaloka, Olivia Taniaga, and for today we will present about deferred tax material. The definition of deferred tax. According to PSAK number 46, the definition of deferred tax can be understood from 2 points of view. First is deferred tax assets. Deferred tax assets is the amount of recoverable income tax in the future periods as a result of deductible temporary differences and the remaining compensation for losses. Deferred tax asset arise when the time differences causes a positive correction so that the tax expense according to accounting is smaller than the tax expense according to the tax regulations. Second is deferred tax liabilities. Deferred tax liabilities is the amount of income tax expense payable for future periods due to taxable temporary differences. Deferred tax liabilities arise when the time differences causes a negative correction so that the tax expense according to accounting is greater than the tax expense according to the tax regulation. And what is benefit of deferred tax? The value of the assets or the deferred tax benefit will write off the tax liability. Therefore, there are no further liabilities to be paid in the future. This asset's value or tax benefit arises from the difference between accounting profit and tax profit. Deferred tax is highly correlated with PSAK number 46 concerning accounting for income tax. Income tax expense consists of current tax expense in current year and deferred tax expense. Tax expense is the aggregate amount of current tax and deferred tax which is calculated in the calculation of accounting profit or loss in a current period as expense or income. Current tax is the amount of income tax payable on taxable income in the current period or year, and the current tax amount is the same as the tax reported in the SPT. Taxable temporary differences is a temporary difference that can lead to a taxable amount in the calculation of future taxable income when the recoverable asset is recorded or the carrying amount of the liability is paid. Next is inter-period tax allocation. There is 3 kinds of tax allocation. The first is deferred method. Deferred method is deferred tax calculation. Using the deferred tax method tend to emphasize how much tax can be saved at this time. The second is asset liability method. Asset liability method is the calculation of deferred tax using the liability method, emphasizes how much income tax will be paid in the coming period. And the last is net of tax method. This method takes into account the tax effects that arise when temporary differences occur, whether the calculation is using the deferred tax method or the liability method.
Okay, I'm Aisyah. I'm gonna explain about the accounting treatment for deferred tax. Accounting treatment for deferred tax is regulated in the Statement Financial Accounting Standards number 46 regarding accounting for income tax, which is officially issued by the Indonesian Institute of Accountants. Deferred tax accounting consists of four activities, namely recognition, measurement, presentations, and disclosure. The first is recognition. The recognitions of assets and tax liabilities that is deferred in the financial statement. This means that companies that prepare financial statements can recognize the carrying value of assets or will pay off the carrying value of the liabilities. Temporary differences that can increase the amount of tax in the future will be recognized as liability. Tax payable is deferred and the company must recognize deferred tax expense. The second is measurement. The deferred tax measurement will be calculated using the applicable rates in the future as stated in PSAK number 46, paragraph 30. The measurements of deferred tax liabilities and assets should be deducted using the tax rate that will be applied to the period in which the asset is realized or liability is paid. That's it. The tax rate is substantially in effect at the balance sheet date. Technically, the recognition of deferred tax liabilities and assets is carried out against the tax losses that can still be compensated. And then the third is presentation. Deferred tax assets and liabilities should be presented separately from current tax assets or liability and presented as a non-current item in the balance sheet. Meanwhile, deferred tax expense or income or benefit should be presented separately from current tax expense in the company's income statement. The tax assets and the tax liability must be presented separately from other assets and liabilities in the balance sheet. Then the last is disclosure. Disclosures of deferred tax is regulated in PSAK number 46, paragraph 56 to paragraph 63. In paragraph 56, several matters related to deferred tax are explained and must be disclosed in the notes to the financial statement. There are the amount of current and deferred tax arises from transactions which are directly charged or credited to equity. A description of the relationship between tax expense and accounting profit in one or both of the following forms. First, reconciliation between tax expense and multiplications result of accounting profit and applicable tax rate by disclosing the calculations basis of the applicable tax rate. Then, reconciliations between the average effective tax rate and the applicable tax rate by disclosing the basis for calculating the applicable tax rate. And then, change in prevailing tax rate and comparison with a rate in effect in the previous accounting period. The last is the amount and time limit for use, if any, of the deductible temporary differences and the remaining losses that can be compensated from the following year and recognized as deferred tax assets on the balance sheet. Okay, the next is the example for deferred tax liabilities and deferred tax assets. For the deferred tax liability, it is assumed that the income before tax and the taxable income before accumulated depreciations are the same amount. It is 200 million rupiah. Depreciations according to the company's books using the straight line method amounts to 20 million rupiah, while depreciations for the tax purposes which use the declining double balance method amounts to 30 million rupiah. If the tax rate is 30%, the calculations and the journal of the data will be as follow. You can see in the table penghasilan sebelum pajak in book value 200 million rupiah. The tax basis is none. And then penghasilan kena pajak, it is in the tax basis table, it is 200 million rupiah. For the accumulated depreciations, for the book value is 20 million as the question said it using straight line method. And for the tax basis, it is 30 million rupiah because it used double declining balance method. And because of that, the tax basis for the book value and for the tax basis is also different. Then the tax expense for the book value is 54 million rupiah and for the tax is 51 million rupiah. And the journal entry for this case is tax expense in debit 54 million rupiah and tax payable and deferred tax liability in credit. Tax payable is 51 million rupiah. Deferred tax liability is 3 million rupiah. Then the example for deferred tax asset. If it assumes that there is a temporary difference of 500 million rupiah at tax rate of 30% and a tax benefit of 350 million rupiah, it is estimated that more than 50% of the realized tax will be realized. The deferred tax assets will be recorded on the balance sheet as shown below.
The next is intra-period tax allocation. Intra-period tax allocation occurs when there are tax burdens that are spread across several parts of the financial statements for the current year. The causes of the difference between income before tax and taxable income, and potentially also the difference between income tax expense and income tax payable, can be categorized into the following 5 groups. The first is permanent difference, the second is timing difference or temporary difference, the third is compensation for loss, the fourth is investment tax credit, and the last is intra-period tax allocation. The next, deferred tax presentation on the balance sheet. The deferred tax account is reported in the balance sheet as deferred tax asset and deferred tax liability, which is classified as net current amount and net non-current amount. Each deferred tax asset and deferred tax liability is classified as current or non-current, based on the relationship with the classification of asset or liabilities reported in the financial statement. The relationship is presumed to exist if there is a reduction in asset or liabilities, which will cause difference in recovery times or vice versa. If there is deferred tax that is not related to a specific asset or liability, the classification of whether it is a current account or a non-current account will largely depend on the anticipated recovery period for such temporary difference. The next, deferred tax presentation in the income statement. Income tax expense on gains presented in the income statement must be divided into 2 components. Namely, the first is current tax, the second is portion of deferred tax. Significant components related to tax expense resulting from continuing operation can be disclosed as follows. The first is current tax expense or benefit. The second is deferred tax expense or gain. The third is investment tax credit. Next is government assistance. The next is profit due to compensation for loss. The next is tax expense resulting from the allocation of certain tax advantage, adjustment of deferred tax liability or deferred tax asset. The last is adjustment of allowance for valuation balance at the beginning of the year. That's all from us. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.